And for one, these are inherently strong business models. They're asset light, they're easy to scale, and with ample room for expansion. And another reason is that the ones we own have come down in, price and valuation a lot due to concerns about the possible disruption of their business model. And that's why I see the next big narrative in our portfolio, Alphabet, Adobe, and Uber. All those are companies that trade at low or reasonable prices because of megatrends like AI or AVs, and they are supposed to hurt their business model. And for all three companies, we argue, as you've heard in this episode, that in fact they are beneficiaries of these megatrends, or in Alphabet's case, at least not in as much danger as the market currently believes.
Hey guys, today we are doing a special type of episode. Rather than break down a new company and have one of us pitch it to the other like we usually do, this week we'll take some time to discuss our current portfolio and reflect on what has changed, if anything, since we first looked at those companies. So we'll give a short pitch on each company we own, explain why we added the position, and discuss whether we are still convinced by the opportunity. I think this will be particularly interesting for the positions that I added to the portfolio before Daniel joined the show as a co-host and had the chance to give me pushback on those ideas. So now Daniel is going to give me some feedback and tell me where I went wrong in my original thinking. And jokes aside, since the show has been running for about half a year, we have covered 25 companies pretty in depth. And that's a pretty cool thing. And it just makes sense to revisit those names and provide some updates and specifically pay some extra attention to the companies that we hold in our portfolio. And of course, we also want to talk about the broader strategy of the portfolio that we're building. How do we think about position sizing, especially as the portfolio starts to fill up? And what type of investments do we want to look for? What is our investment criteria? What are our expected returns? Are we looking at compounders, value plays, growth companies at a reasonable price? Do we not want to use those labels at all? I think to different extents, we probably have companies that could be classified with any of those labels, but still, we'll get to all of that. And before we start, as always, I'd like to just quickly emphasize that this show and the portfolio we're building are strictly for entertainment and educational purposes. This is by no means meant to be financial advice for anyone to just follow and simply go off of our recommendations. We haven't and can't consider your unique situation. Okay, with that said, Daniel, where do you want to start?
25 episodes, that's a lot. At the end of our episodes, you often say the train just keeps moving, and that's true. It feels like time just flies by. For today, though, how about we start with some of the portfolio positions, as you just mentioned, that you added before I even joined. And if I'm not mistaken, that should be Ulta Beauty, Alphabet, and Airbnb. And until recently, Ulta Beauty has actually been a 7% position in our portfolio. So besides Alphabet, which we recently decided to make the largest position yet at about 8%, Ulta had been the second largest position for quite some time in our portfolio. Now, you don't have to convince me to make larger bets, but Ulta didn't strike me as this phenomenal investment opportunity that would justify this weight in our portfolio. But that's also why last week we decided to take Ulta's jump after a very good set of earnings to rebalance the position slightly. It's now 5% of the portfolio at an average buy-in price of about $400, which means that the stock has already delivered a return in the high teens for us by now. And with the stock and its current position size, I think it's in line with Adobe and Airbnb in our portfolio. And I think that's fair regarding our conviction in each of these stocks, despite them having pretty different risk-reward profiles. You actually reached out to me about reducing the position, so I think that we are both fine with taking some profits here and rebalancing the position size. To provide a brief overview of the pitch, since it has been quite a while since you pitched it on the show, I see Ulta as a company that generates strong returns on capital. It has a buyback program in place that should benefit shareholders by repurchasing, I think, about 4 to 6% of stock a year. And it has a store concept that significantly improves the shopping experience. And I think that last point is really important because retail is a tough business, and even tougher when you're directly competing with the likes of Walmart and Amazon. I mean, I've just randomly before the episode compared prices of some Ulta products to the prices that you would have to pay at Walmart or on Amazon. And it seems like you can simply buy the same product cheaper on Walmart or Amazon stores. So Ulta needs to deliver some form of value add to bring to customers and make customers go to the store. And I'm the first to say that I have limited knowledge on beauty products and the shopping habits of, beauty consumers. But I am a regular user of skincare products. And for me personally, it's all about continuity over variety. And once I find a good product, I just keep buying that. I'm not necessarily looking for new ones a lot. And I think Ulta's strength mostly lies in its in-store experience and the opportunity to find and test new products, right?
Yeah, I think that's kind of what sets them apart. In your Amazon episode, you discussed Rufus, which is Amazon's new AI shopping assistant, kind of designed to replicate the in-store shopping experience as much as possible online. But ultimately, I don't see that replacing what Ulta can offer in their stores. I visit them actually quite often with my wife, and the expertise you get from their salon and skincare professionals is just on a different level. Beauty is inherently an in-person and customizable experience. It's different for each person. And I know they don't have Ulta locations in Germany, Daniel, though they are expanding internationally in Mexico and Dubai. But you would see exactly what I meant for anyone who can visit an Ulta or Sephora store in person. It's totally different from going to Walmart, where you can't test out products and get advice from professionals in the same way. And that really does matter, as I've learned, to a lot of women and men out there. And then there's Ulta's loyalty program that we talked a lot about in the original episode that works phenomenally well for them. 95% of sales come from loyalty members, and 76% of loyalty members shop solely in person because they want to connect with the people there and get that exact experience. The closest competitor on that end is Sephora, as we've talked about before, especially in our LVMH episode. However, I found that customers are much happier with the Ulta loyalty program because it offers much more value than Sephora has been willing to give away for free. That's probably because Sephora's tied to this luxury conglomerate and they don't want to dilute their status by giving away a bunch of freebies. But Ulta is truly a universal retailer with a blend of mass and prestige beauty products that I think makes them more diversified across the economic cycle and also more ability to lean into mass market, non-prestige products that they can give away for free as part of their loyalty program.
But if I'm not mistaken, when I went through all the reports that Ulta put out, the most profitable customers are the ones shopping online as well, right? Not only in the stores. That's why Ulta's app offers these high-end features that you also mentioned in your pitch, something like skin tone analysis through augmented reality and pretty cool features like that. And I sometimes hear the argument by people that this should be easy to replicate by, sites like Amazon. And sure, they could if they wanted to, but what's important to understand here is that huge companies like Amazon cannot delve into the nitty-gritty details of each industry they are operating in. And the opportunity cost of, putting software engineers on that topic on such an app is just too high when you have much more important and profitable projects going on. And the customers that go to specialized stores, especially the Ulta Beauty ones, they also want specialized services and niche, if you can say that. Operators like Ulta Beauty will always have a better understanding of the customers and be better at providing that service. And something like Ulta's loyalty program is also only imaginable for specialized beauty retailers. Now, getting to the financial side of things, we just talked about Ulta's jump after earnings. So how about you give us a summary of what the earnings look like and why the market liked them so much?
Yeah, so Mr. Market really did like what he saw. In part, that was because of, I think, the macroeconomic fears that had dragged down expectations a lot. But beauty spending can be quite resilient at those times, and Ulta has proven that yet again. In economics, this is literally known as the lipstick effect. If you can't afford to buy a new car, you might splurge on small luxuries at a place like Ulta. And revenue grew 4.5% in comparable sales. So sales at stores that had already been open for at least a year also grew. And that was mostly driven by an increase in the average ticket size of when people are checking out and less so by more transactions, a higher volume of sales. And fragrance was the strongest performing category for Ulta, led by some new partnerships with Khloe Kardashian and Billie Eilish. And getting back to our discussion of the in-store experience, Ulta hosted something like 20,000 in-person events across their stores to promote these new brands and products this past quarter. And these were seemingly very well received by Ulta customers. And it's part of what makes the brand customer relationship so special for them. But it's not only about the physical stores. E-commerce sales rose 10% year over year. And more than 60% of those e-commerce sales came from their app that you mentioned, Daniel. So that's a channel that Ulta directly owns and can monetize very effectively. And I've been and continue to be a bit skeptical about the international expansion plans that they have, but it is undeniable that international growth could be a major long-term growth engine for them if they can just recreate a fraction of the success that they've had domestically when going overseas.
I think you mentioned in your pitch that you would like Ulta to go to Canada or not maybe so far away because you just feel like the strategy would work better over there. What I really thought when I saw these earnings was it's amazing how resilient the business is. Although we generally see in retailers that tariffs do not seem to be a problem right now, so perhaps later on in the year. And speaking of them, of course, as in every episode, we need to talk about them. Were there any mentions of tariffs or the general outlook for the rest of the year?
So the outlook for sales and earnings per share was actually raised for the year. And according to Ulta CFO, they're pretty confident that they can mitigate any cost increases by working closely with their partners. And it helps that they don't really directly source products themselves. They're not doing a lot of direct importing. They rely on their brand partners. So think companies like Estee Lauder and Elf to act as intermediaries on tariffs. Those brands kind of act as a buffer and absorb some of the cost increase, reducing the amount that Ulta then has to absorb itself through either higher prices for the end consumer or just with its own margins. And there has also been a 11% increase in inventories at Ulta, as we've seen with a lot of retailers this year. And that's maybe usually not a good sign, but in this case, it's more of a strategic move to dodge tariffs in the short run by importing supplies in bulk ahead of when they go into effect to try to reduce those inventory costs for as long as possible. And as we've discussed, beauty products tend to be a necessity rather than a luxury for most people. The beauty category has very much come to overlap with wellness, which is one of the things that drew me to Ulta originally, and which has increasingly become a core part of people's identities in mental health, that idea of wellness. And when you combine that with Ulta's highly loyal customer base, I really do feel like they could be okay in almost any environment, no matter how difficult. I mean, even the pandemic wasn't really enough to severely disrupt Ulta's business.
We will talk about another business today that also had pretty high inventory levels, but it wasn't like Ulta where that was planned and part of a bigger strategy, but it's actually, dragging the business down, but we'll get to all of that. For now, let's talk about Ulta's stock for a minute, because I think the stock isn't cheap anymore, right? I think the market appears to have recognized that Ulta might be worth much more than was given credit for a couple of months ago when you started building the position. And when I look at your model, Ulta actually seems pretty much overpriced by now. The fair value estimate is about $425, and at today's price of around $470, your model would imply an expected return of less than 6%. Our usual threshold for an investment is about 12%, so perhaps you were either too conservative in your model or anything else changed. Could you walk us a bit through your thinking and the modeling? Is there no upside left, or what should we do with our position given that model?
I do think the model is a bit conservative. And like you, Daniel, I think we're both believers in letting your winners run, as they say. So it sounds contradictory, and it's a very nuanced thing, but I do think there should be a different threshold to some extent for when we're considering the expected returns of new positions versus existing positions, where we want a very high threshold to approve a company into the portfolio. And then we're allowing for a certain degree of trust in those companies once we have invested in them. And then, as in once we've built a position and we get to a point where we don't have any more excess cash to allocate, then it starts to make more sense to be more concerned about the opportunity cost, which I see as being different from when we're doing our initial assessment of a new position. I only really want to exit a position if the thesis changes or if the valuation just gets absolutely crazy, which is not what's happened in Ulta's case. Because if every time the stock is 5 to 10% above fair value, as kind of what is happening with Ulta, you find yourself in a situation where you're really not long-term investing, but you're trading. And that's not what we want to be doing. But you're right, though, at current prices, I'm not eagerly looking to get back into the stock and add to our position in it. And obviously, we actually trimmed the position a little bit to account for, I would say, you having a bit less conviction in the idea than me. And I will say, though, if we get a chance to buy Ulta at $380 or below again, or even closer to $350 when Ulta really first caught my attention, then again, I would start to feel, okay, hey, I can feel pretty good about personally adding to this position if we get a much better price, and maybe extending the position beyond that baseline 5% size. And with a pretty aggressive buyback program in place that you mentioned that buys back 4 to 6% of the outstanding stock in a given year, just because the business is so profitable and spits off so much cash flow to enable them to do that, plus any just modest domestic expansion of the business, so new store openings around the country or higher per store sales, any internal efficiencies, and they are in the midst of a big push to drive efficiency internally that could boost margins by lowering costs, and then just better monetization of all their data, right? 40 plus million loyalty members, that data is very valuable. And we're seeing them trying to monetize that through their UB Media advertising network. And then also you layer over the potential for international expansion. And I just think, okay, I feel pretty confident that this is not maybe an obvious home run at current prices, but on a 5 or 10 year time horizon, I feel pretty confident that especially at the price that we entered this position at, they're going to compound capital at attractive rates on a long-term time horizon. And like I said, unless the valuation just gets totally crazy, I don't want to disrupt that compounding too much.
That's what I like about Ulta. Compared to some other stocks that we own or hold currently, it's just a rather stable and slow compounder, but it's producing cash flow. And as you said, it's a bit difficult to know when to sell a position because it gets too expensive. Because where do you draw the line? Is it at 30 times earnings, 35, 40? You just never know. And that's why we have this tendency to keep winners running. And I think that's the right approach to go about this, especially when you look for compounders. Now, I don't need to have Ulta at a position much larger than 5%. But as you said, if we go and see prices that are in the 350s, 360s, I can definitely see a case for that happening as well. Now, getting to the next company, Alphabet. Alphabet is a company where both of us are completely aligned, I would say, regarding the opportunity. Google is 8% of our portfolio, and that reflects our conviction. And it's currently down about 2% since we added the stock to our portfolio. But year to date, it looks even a bit more grim. The stock is down about 8% at the time of the recording, but it has seen a rally of about 20% since the tariff lows in April. So it reminds me a bit of the Amazon situation, although Alphabet is significantly cheaper overall, and that's mainly because investors expect Google's search business to lose market share to ChatGPT, Perplexity, and all the other AI tools. According to some reports, its market share in search actually dipped from 98% in January last year to 92% now. And I would like to add one note here that I think is important. There are two things that you as an investor should take into account when you look at Google. That is market share and the overall search volume. Shawn, you mentioned in your Google pitch that you use Google more because of ChatGPT. They often work hand in hand with many searches, and I see that too in my use of Google and ChatGPT as well. In such a scenario, Google's market share could actually drop, but overall search volume would actually go up. We'll get to Google's latest results, but one thing that you will see is that the search business actually grew 10% year over year. And if they would lose market share on stable search volume, they couldn't grow, especially since AI results are usually harder to monetize than the original search results. The latest Apple news didn't help Google either. I mean, first, Apple released news that Safari search saw its first decline in search volume ever. And then we heard of a potential partnership between Apple and Perplexity, and a rumor that Google's deal with Apple, therefore, would vanquish. And that deal was basically made so that Google would become the default search engine on any iPhone. And that deal might come to an end now. And It's a deal that cost Google, $20 billion a year, but it's also estimated that Google benefited from this deal to an extent worth about $25 to $30 billion a year. And not only Apple, even Samsung, which uses Google's Android system, is now negotiating a deal with Perplexity that would preload Perplexity onto its phones and integrate it into the internet browser. I think there's not too much debating here. This is not a good sign for Google. Search is almost 60% of Google's revenues, and it's the highest margin business. So if that business deteriorates further and as fast as, some of the analysts expect nowadays, it would be hard for Google to make up for that with other segments. Now, with all of that background, how do you feel about it? And why don't you tell the audience why we think this is not going to happen? If you enjoyed this show, I would bet that you would love our Intrinsic Value community. It's a private network for sophisticated long-term investors who care about deep research, sharing actionable investment ideas, and making meaningful connections with like-minded individuals. Besides reading all the value investing books I could get my hands on and doing my own valuation work, nothing helped me more than getting feedback from a group of sophisticated investors with diverse backgrounds and distinct circles of competencies. We also host calls with a variety of experts and investing professionals who share their unique strategies and insights with our members. But we are only opening up 30 spots for a limited time. They will probably fill up fast, so if you want to invest better and surround yourself with people who do the same, you should join our waitlist for the Intrinsic Value community at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community.
Hey guys, this is your host of the Intrinsic Value Podcast, Shawn O'Malley. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout. We are value investors. That's the whole point of the show. So of course we love to make a little extra money. And for someone who loves to travel as much as I do, like I just did to Austin, Texas for a friend's wedding, you really need to take advantage of all of the small ways to make a little extra money when you can. Fortunately for me, and for anyone who travels frequently or has a second home, using your house as an Airbnb to earn income with is the easiest it's ever been, thanks to Airbnb's new co-hosting network. All I had to do was provide the space, get paid, and they handled everything else. It's that easy. With Airbnb's co-host network, you can hire a sophisticated co-host to take care of your home and guests without the stress. One of my childhood friends' family owns at least 2 vacation homes that I know of, one in the mountains and one at the beach, and it blows my mind that they don't list their home on Airbnb as a way to monetize those properties that are, well, let's be honest, empty for most of the year. They would be the perfect candidate for working with a co-host through Airbnb. If you have a second home, travel often, or away for extended periods of time, go find a co-host at airbnb.com/host and start earning extra money today.
That's a great setup, Daniel. Thank you. And the easiest way to explain it is to look at how I actually use both tools in my day-to-day life. When I open ChatGPT, it's usually for fairly maybe narrow tasks. Like I'm checking an Excel formula, polishing a paragraph, answering new types of research questions that I've never would have searched for on Google anyways in the past, or maybe even for some folks out there, not me, but troubleshooting a bit of code. Those queries aren't really search as they would have classically been defined, at least from a perspective in advertising, since they are hard to monetize. How do you monetize me asking about an Excel formula? And because of that, there are different types of searches. It's a new type of behavior that we're seeing that never happened before. And that's why I don't think it threatens Google's core business. And that's why I think Google's core business is still growing, even though supposedly its market share has declined. The most valuable types of Google searches aren't the types of questions I would probably typically ask ChatGPT. For anything that involves a real world decision, like maybe checking the opening hours of the nearest pizza place or finding a new gym, I still find myself reaching for Google. And maybe that's not true for everybody, but I think for most people, that's still the case. The results page just gives me addresses, photos, reviews, quick routes and maps on how to get there and see where it is. And all of that interface has been built out over 2 decades. And Google has done a really great job refining that. And for these kind of real world interactions, which tend to be the most monetizable from an advertising perspective, I'm still always going to choose Google. And so, for example, local businesses can advertise to appear at the top of those kind of searches. And that is really specifically what makes those searches valuable for Google and actually sometimes more helpful for me as a user. And in practice, the two services sort of complement each other, actually. I might ask ChatGPT for workout ideas or even for a list of nearby gyms, but before committing, right, I'm not going to just sign up through ChatGPT. I probably still want to see the pictures and compare ratings and maybe even read a few local reviews. And I think a lot of those steps are still happening on Google, and that should leave, in my opinion, Google's search business intact for the foreseeable future. As you said, I think the total search pie is growing very quickly, and we're finding new ways to consume information, but I don't think that has to entirely come at the expense of Google's core business. I find myself increasingly using Google's AI overviews actually for quick answers, where I also want to see a list of websites at the same time. And recently, I've noticed that Google is embedding more ads directly into and above these AI overviews. So we're now starting to see a preview of how this will actually be monetized. Perplexity and ChatGPT are definitely threats on the margins that appeal to techie types of people that are early adopters of things and younger members of the workforce. And like we said, they kind of enable new types of searches. But I'm not convinced when we zoom out and we look at billions of people across the planet that these things are cannibalizing core search yet. The median person globally is just probably not tech savvy enough to really truly abandon Google, or at least be as curious about experimenting with AI as you and I, Daniel. So it's just something for us to keep in mind before we get too far ahead of ourselves about this narrative that Google's being displaced. I'll believe it when I see it.
A bit caution about all of the AI news is, I think, what everybody would benefit from a bit. Although I'm far away from calling myself an early adapter in terms of, using AI and new technology. Of course, it's anecdotal, but as you know, I'm just in the process of booking a trip for my summer vacation, and we're not yet entirely sure where to go. But when we looked for destinations, we almost exclusively used ChatGPT for everything from how the weather will be, what you can do there, how to get there, pretty much everything. And when we wanted to look for potential places to stay, then we just went over to Airbnb. And when you mentioned checking for, the nearest pizza place, the gym, or anything like that, I thought this sounds exactly like what Airbnb is now trying to do with experiences. And that's basically a new service that we will talk about when we get to Airbnb. But it's still impacting, at least it could impact Google in, a couple of years. It's not like I'm less bullish on Google now than I was a couple of months ago. I just like the valuation for that way too much. And honestly, just today, I probably spent about 5 hours in aggregate on Google's ecosystem. But I can't say that I don't see strong competition in search just right now and probably also in the years ahead. Google has to be on top of its game to remain as unchallenged as they have been for a long time. But as you said, with Gemini and these search overviews, they did a huge step in the right direction. And I already said that in one of the last episodes. Since AI overviews, I use Google search way more often again. I just love this mix between the overview plus website results because it's just so powerful.
Totally. And as we discussed already, when the Apple news came out, this actually might have been a negotiation tactic to get a better deal from Google, or could also have something to do with the case against Google. and their monopolistic behavior. And what I mean is Eddie Q, Apple's senior vice president and the person who made these comments, mentioned it while testifying on the case against Google and their monopolistic behavior. And by linking the dip to users testing ChatGPT or Perplexity instead of typing into Google, Q is effectively arguing that Google's dominance is already eroding on its own. And that helps Apple on several fronts at once. It undercuts the Justice Department's narrative that the default search deal smothers competition, protects the roughly $20 billion that Apple earns annually from Google by suggesting no dramatic remedy is needed to address that deal they have in place. And it kind of lays the groundwork for adding AI engines to Safari without there being this feeling that there's an abrupt breakup. And it also gives Apple extra leverage in renewing the Google deal and negotiating it. So who knows? That's just a little bit of conspiratorial speculation about the real intentions behind those comments. But we also shouldn't forget that Alphabet is much more than search. For anyone who listened to that podcast I did solo on Alphabet, I mean, there is a lot going on behind the scenes, a lot. I mean, buying Alphabet today is almost more of a bet on the future of YouTube and its cloud business, while also just assuming that search won't totally fade away as imminently as people fear, with some call options on some really exciting cutting edge technologies that Alphabet is kind of uniquely positioned to develop and invest in. So yes, we need to keep everything in perspective. And even with Eddie Q's comments, I wouldn't be surprised in hindsight if these looked more like noise than true signal.
For every listener out there, I really can just recommend listening to the Alphabet episode, because just talking about search is not doing that business justice. It's just so huge. But we need to focus on search here because, we're just giving a quick update and this is what the market is focusing on. Having said that, in the EU, the Digital Markets Act actually made it much easier for users to switch their search engine already for a couple of years. And while there are reports that, this caused some smaller search engines to see more traffic, that's more of a rounding error for a company like Google. And I've yet to see anyone who is not using Google Chrome. So I guess you're onto something there. I don't think search will go away anytime soon. All right, but enough of that topic. Before we close the Google chapter, how about we discuss the latest results and then quickly talk about another topic that has gotten quite a lot of attention recently, and that's Waymo. Waymo has recently reached the 10 million mark of paid robotaxi trips. That's a doubling in just 5 months' time. And yes, all of those trips have been across Austin, LA, and San Francisco. So it's far from being nationwide yet, but it's still a huge number considering that Tesla has yet to start with any rides.
It's fascinating to see how many people ignore the huge achievement that Waymo has done here by saying that it'll be harder to expand to other cities or other countries. But right now, Waymo is really far ahead, and there have been no major crashes yet. After 10 million rides, there's only been one crash with a fatality that I know of. And in that case, the Waymo was actually not the one making a mistake. It was the other driver that crashed into a line of cars, with one of them being a Waymo. So I don't know who the winner will be in this space, but Waymo's growth chart is as exponential as it gets. And combined with that Uber partnership, another one of our portfolio companies, I think we're talking about a serious advantage here. Every mile that a Waymo car drives is a mile of data that it gathers. That compounds when you're doing 250,000 rides per week. And the self-driving system you see in your average Tesla is more of what you might call a level 2 system, whereas Waymo is arguably operating at level 4, with the difference being that level 2 is a supervised system. So there needs to still be a driver at the wheel, while Waymo's level 4 system allows it to have no driver at all. That's the difference in sophistication here.
Waymo's cars have all sorts of different sensors, but most notably the so-called LiDAR technology. That's basically just a form of laser which is used to locate objects and assess their range. And Tesla only uses cameras, so that's a lot cheaper and it's easier to integrate when you focus on, selling as many cars as possible. But it's a very different game from what Waymo is playing. But of course, Waymo, with all its sensors, cameras, and lasers, should work better than Tesla's only using cameras. But I guess the big question is not whether Waymo works better than Tesla, but whether Tesla works well enough. Because if it's good enough and Tesla reaches level 4 of self-driving capabilities, then it can obviously expand rapidly, much faster than Waymo, since LiDAR just takes much longer to be trained on new terrain. And Tesla is already operating millions of cars on the streets around the globe. And one over-the-air update, and millions of those cars turn into a fleet of self-driving cars.
That's true, but Tesla has promised to be at that stage for like a decade now, and they still aren't. Waymo is there though. Tesla will soon start to own their own robo-taxis in Austin. At least that's the plan. And it'll just be really interesting to see how that plays out. Generally, Waymo and Tesla are almost fundamentally different in their objectives. Musk has said that Tesla's full self-driving should be as good as humans, while Waymo CEO has said that it needs to be significantly better than humans. And that is actually a big difference in terms of safety and reliability. And I consider Waymo's approach to be smarter. If robo-taxis are not materially safer than human drivers, I do think it'll be much more difficult to obtain the regulatory approvals to operate them on a large scale. And Waymo, for what it's worth, has basically already proven that it can operate much more safely than the average human driver. Tesla, on the other hand, has a lot of other things going on. I mean, Musk's attention is divided between a number of different companies and politics, and Tesla is building robots, for goodness sake. So again, I tend to think the company with the pure play focus will end up winning. That's my oversimplified framework that we bring to a lot of companies. And it's just that specialization wins. It's why I like Spotify. It's why I like Ulta and beauty retail. And it's kind of why I like Waymo here with self-driving vehicles.
That's a powerful concept. I mean, you've seen Tesla going all different sorts of routes, and Elon Musk even more so. Waymo has done what Musk promised for years, and who knows if that will change in the coming months. But we could spend a whole nother episode on covering Google and everything they do. But before we get lost here, let's just briefly talk about the Q1 results and whether they support our more bullish outlook and I think the market's more bearish outlook. Without being too biased, I think you almost have to read the latest results positively. Revenue was up 12%, reaching over $90 billion. Net income jumped 46% to almost $35 billion. And margins expanded despite record AI investments. And on top of all of that, an announcement to increase the dividend by about 5% and $70 billion worth of stock repurchases. But most important, at least in my mind, is that we saw search not only growing 10%, but that these new AI-generated search overviews that we've already talked about, those summaries Google places at the top of search results, are already reaching 1.5 billion users per month. And that's not too surprising since Google's reach. But according to management, they are also monetized at roughly the same rate as regular search ads.
And the cloud segment also did very well, right? Revenue jumped 28%, and the operating margin, which is really what I saw as the most important thing to track, almost doubled compared to a year ago, hitting 18%. And if we compare that to AWS or Azure, there is a reasonable argument to make that the margins could double again before they stabilize. And if so, in the coming years, the cloud business could easily be worth as much or much more, given how much faster it's growing than the search business. And as you pointed out in your Amazon episode, Daniel, AWS operates on margins of nearly 40%. And while the three services are not identical and their customers can differ, it does seem likely that the margins of the big three will be in the same ballpark long-term in the cloud business. So I think it's safe to say we remain pretty bullish on Alphabet. And despite a 20% rally since the April lows, we still find it to be the cheapest of the Mag 7, which is, the highest quality group of companies in the world, and very reasonably, if not cheaply, priced.
Yeah, I totally agree. It's our biggest position, and I definitely do not lose sleep over that. Now, let's get to a position that we have already talked about a bit, thanks to Waymo, and that position is Uber. Uber is currently only 2% of our portfolio and has been the best performer, returning about 40% on an average buy-in price of about $62. The partnership between Waymo and Uber enables Uber basically to use and order Waymos and their services in cities such as Austin, Phoenix, or Atlanta. And among investors, there are still mixed feelings about this partnership, as Waymo was originally seen as a competitor to Uber. And in the end, why would anyone need an Uber if Waymo exists? We already covered that in our Uber episode, but how about you quickly shed some light about why Uber and Waymo can actually coexist and perhaps even work better together?
Okay, so for anyone who has known me personally for a while, I would say they would know that I was not a big believer in Uber for the longest time. Like, I was the person who was like, this is a terrible business. I don't understand how they make money long term. These margins aren't sustainable. People aren't going to pay $20 for a 10-minute ride. All of these things. I asked myself that same initial question too. Isn't Waymo an existential threat to Uber? And so I came into the Uber episode thinking that I was going to really dislike the company and there was no chance I was going to own it. And maybe that's a testament to just trying to be open-minded and allowing your thinking to change. Because the more you study the autonomous vehicle space, the more, at least I realize, that Uber and Waymo need each other much more than it first appears. And once you realize that autonomous vehicles don't seem like a major risk to Uber, but actually a significant opportunity as management, I think, genuinely believes, then the partnership just makes even more sense. And Waymo and Uber each solve each other's biggest headaches. Waymo has this world-class self-driving tech, but it needs access to dense, reliable demand for robotaxis worldwide. And Uber already funnels ride requests from 170 plus million monthly users. And by plugging Waymo's fleet straight into the Uber app, Waymo gets this near instant high utilization rates for demand and avoids the cost of building its own consumer marketplace from scratch, which is just incredibly, incredibly hard to do at scale. And at the same time, Uber brings a supply of fully autonomous cars that shorten wait times and bring in higher commissions since there's no drivers involved and may have lower insurance costs in the future. And it just future-proofs its business model by turning competitors into suppliers. And so AVs are already busier per vehicle than 99% of human drivers in the areas they operate in. The latest expansion to Austin and Atlanta will put hundreds of Waymos under Uber's dispatch by early next year. And for Waymo, as well as other AV companies, building your own fleet of cars large enough to meet the demand of basically Uber's network would require just unfathomable CapEx investments. Because what Uber is doing with variable human driver costs, you would be trying to do with these CapEx heavy fleet of autonomous vehicles that just have a ton of physical hardware and technology embedded into them. And that's just a totally different cost structure. It's a very, very capital intensive venture. And that problem doesn't exist with Uber. Uber's drivers are much more flexible in responding to demand. And autonomous vehicles can fill the gap and offer unique experiences for customers at the same time. And so for the foreseeable future, I actually think Uber's core network of human drivers will almost be like the baseload of power for an energy grid or for their network, while Waymo's kind of take on the role that we see renewable energy sources take on, which is adding capacity on the margins, but it's not fundamentally replacing the baseload power in most cases, which is typically, like on an energy grid perspective, things like coal, natural gas, and nuclear. So I don't know, that's my energy metaphor. It makes sense in my brain. I don't know if that makes sense to anyone else.
I love that metaphor. I think it's great. And this is the heart of the thesis, right? It makes much more sense for AV companies to just partner with Uber instead of competing with it. And since operating a massive fleet of AVs just doesn't fit the volatile and non-linear nature of the ride-hailing demand and business, I suppose one of the biggest problems is actually just where to park all these excess cars during periods of low demand. I mean, with all the available data, I think it shouldn't be that hard to, build an algorithm that predicts how many cars will be needed at a certain part of the city and at a certain time. But where do you store cars during periods of low demand? I wonder though if one day we will see many more car companies going the route of self-driving cars. I might be missing something here, but where's Uber's value proposition when your own car drives fully automatic? Tesla even thought about a service where you can offer your own car or your own Tesla as a robotaxi to other people when you don't need it. And I know this is all many, many years ahead, and there are many things that, just couldn't work out in that thesis. The most likely outcome is that Uber just dominates the space for years to come. But for my Mercedes episode, I looked into the driver assisting systems of many car companies, and sure, they are far from Waymo and also way behind Tesla. But since it's becoming clearer than ever that this is the future of driving, I wouldn't be surprised if we do see significant improvements on that front, and especially from Chinese car companies, which are probably the bigger competitive threat here than, European or US brands. Do you see that as a risk at all, or would you say Uber is way too dominant and their specialization is just too big of a factor?
Thinking about the terminal value is the biggest uncertainty with Uber. And my thinking could certainly evolve, and I could easily change my mind as this all unfolds. But the kind of theme for this episode that I keep coming back to is a very simplistic idea that specialization matters. What you focus on matters, in other words. To suggest that car companies can create their own ride-hailing networks, in my opinion, dramatically understates the difficulty in actually running a global ride-hailing network and the flywheel effects associated with it for managing the logistics of tens of millions of people and vehicles, effectively utilizing all that data, and then simply having the network effect in place where supply and demand are uniformly aggregated in one place and are balanced, and all the economies of scale that go with that. I just think building self-driving cars and building a global ride-hailing network are totally different aims. And if some company like Tesla or even Waymo is approaching ride-hailing as an afterthought, as maybe a bonus feature for how your car can be monetized when you're not using it, my feeling is that it's just going to be much easier said than done. And the competition here, I think, actually helps the thesis, because if there was only one car brand in the world and everybody owned a Waymo, then I would say, yeah, they could probably, flip a switch and turn that into a ride-hailing network. But that's just not the reality. And so the question I ask myself is, what is most likely? That some car company recreates Uber's network effect that took 15 years to develop, and then they fully displace Uber? Or more likely, do they just concede that Uber is the biggest aggregator of supply and demand that's agnostic about whether they're working with Tesla, Waymo, or Mercedes, or any other autonomous vehicle manufacturer? And all of these different companies, kind of going with the game theory of it, decide that it makes sense for them to tap into the neutral network effect that is Uber, that sits in the middle of all of these different vehicle manufacturers. And if anything, as more of these companies enter the self-driving arena and flirt with the idea of making their vehicles available for ride hailing, I think that makes Uber's role even more important as a third-party exchange that can bring together supply and demand without bias. And right now, we are seeing Uber make a ton of partnerships supporting this vision. Besides the many AV partnerships with startups and tech companies they have, they've also started to onboard these big legacy car makers in different ways. And so they've just signed a deal with Volkswagen to bring thousands of autonomous electric vans onto the Uber app starting in Los Angeles in 2028. And then you see other car companies give up on their ambitions to create their own robotaxi fleets, right? GM retreated from its Cruise robotaxi rollout and refocused on driver assistance subscriptions now because it was just too difficult to build the hardware and the consumer marketplace at scale at the same time. So I could be wrong, but I see these companies as ultimately deciding that it's more advantageous to partner with Uber for ride hailing as sort of the mirror of Uber's decision to abandon its project to build a self-driving car and just focus on being an aggregator of supply and demand. So we should also mention that roughly half of Uber's business comes from its food delivery business, which is even harder to automate entirely than self-driving, unless we expect there to be armies of thousands of drones in our airspace across the country and across the world that exist just to deliver our takeout orders. Maybe that's one day in the future, but again, I think that's pretty far off.
What you describe is by far the most likely outcome. And my concerns with Uber are probably inconsistent with my usual reasoning, because I tend to rely on today's facts instead of a vision that is 10 years out. And today's facts would just state that Uber is the dominant player in that market. And as you mentioned, the more car companies offer self-driving cars, the more it would actually benefit Uber as, the platform enabling all of that. Before we move on, Uber also released earnings recently, and the stock didn't jump as much as Ulta, but I felt like the numbers were pretty good and they still looked promising. So what do you think about the numbers?
Last quarter, Uber booked 3 billion rides, up 18% year over year, while monthly active users grew 14% at the same time. So most of the growth comes from new users, but also partially from an increase in booking frequency from existing customers, which is a great illustration of the flywheel in effect. People use Uber services more over time after that first initial touch point that they have with Uber. And so gross bookings rose 14%, but if you strip out the currency headwind, it's actually 18%. And you see that scale hitting the P&L now. Operating income jumped by $1 billion to $1.2 billion total, and active drivers grew 20%, reducing wait times and reinforcing the flywheel that makes Uber services increasingly valuable. So we are seeing the full effects of operating leverage and really the vision that Uber's been painting for a decade now coming to fruition. And one of the statistics that makes me most bullish on Uber is that Uber's active customers only represent about 5% of the adult population in the markets they operate in. And about half of Uber's customers use their apps just 1 to 2 times per month versus a global average of 6. So there is a lot of room to drive existing customers to use Eats and Uber Mobility, so ordering rides, more frequently. And speaking of that cross-selling has continued to improve. 1/3 of new Uber Eats users now come directly from their Rides app, the mobility app. And the Uber One subscription is combining that cross-selling ability and further driving low-cost stickiness across mobility and Eats, the two different core business units at Uber. Delivery has turned profitable, and there's still, in my opinion, a ridiculously huge runway left. I mean, this thing is not even close to being done growing in its most mature markets. And just think about all the things that could be delivered besides food, right? They have already signed up partnerships with Home Depot, for example. So if you have any plywood you need delivered, Daniel, do it on Uber next time.
Fortunately, I don't. I don't like building stuff, but I think it's important to just be able to have different opinions in your head at the same time. And for me, it's a bit like that with Uber, because I might see some concerns a long time in the future, but looking at those numbers and all of the different business segments that they have just has to make you bullish. And I mean, you didn't even talk about the ads business yet, right? That was one of the business opportunities that surprised me the most in your pitch. And it seems like there is huge potential there. Ads grew 60% year on year, and it's by far the highest margin business that Uber has. And right now it's still small with about $1.5 billion in revenue, but there's a lot of runway left. And according to management, the mobility ads business is even significantly outpacing the overall advertising growth in the Uber business. And last but not least, we also have a new acquisition. You mentioned Uber's big investment portfolio when you pitched the company. And a couple of weeks ago, it entered the Turkish delivery company Trendyol Go, which was actually backed by Alibaba, by the way. I didn't know if you were aware of that. They bought it for a price of $700 million. In my opinion, that's a great deal. They buy 85% of the company, which generated $2 billion in gross bookings last year, growing 50% year over year. And like I said, they only paid $700 million.
Yeah. Well, just to quickly touch on advertising too, Daniel, I think we both, or at least I personally speaking for myself, I love to use these simple frameworks. And for me, like, this is not rocket science thinking that I'm doing. I'm thinking very intuitively. Uber knows where everybody's going. And that is probably pretty valuable to advertisers to know real time where people are in a city, what their destination is, what they're doing, learning about people's habits throughout the day. To me, just again, that is obviously a very valuable advertising business when you can hit people with ads based on where they actually are in the world at a specific time of day and based on those patterns. And to go back to the move into Turkey, I would also say, yeah, this is their typical playbook. They expand by either acquiring a company that used the Uber playbook themselves in a foreign market, or at least building some sort of minority stake in these companies so they have some upside exposure to companies that have kind of beaten them to running the Uber playbook locally. And this time it's not on the mobility side, but it's on the delivery side of the business.
Yes, and I think we can summarize that we both are excited about the Uber position and that we like this position in our portfolio. Having said that, I would say it's time for the next one. Let's move on. And when I look at it, it just shows me how big Google's influence really is. I mean, we talked about Google quite a lot today, and every second company that we bring up today is somehow linked to Google. The one I'm talking about now is Airbnb, and it's a 5% position in our portfolio, up 6% since we bought it at an average price of about $130. And there have been quite some updates since our pitch. It's a public company that is pretty young. It only IPO'd in December of 2020. And as it often happens at IPOs, the stock skyrocketed immediately after. But since then, the stock hasn't gone anywhere. It's up 1% over the last 4.5 years. But fortunately, that's not the case with Airbnb's financials. The company has grown into its valuation, and what seemed to be overpriced in 2020 is now a company with a profitable business, numerous opportunities for growth, and a very reasonable price. You can currently buy Airbnb at an enterprise value to operating cash flow of 16, and the enterprise value represents the total market value of a company. You get there by adding the market cap to total debt and then subtract cash. For a company growing its top line in the double digits and had a 25% CAGR for free cash flow since 2020, that valuation sounds like a pretty good deal.
Well, thank you for saying that, Daniel, because I agree. I think Airbnb has a lot going for it. I mean, we discussed it all in the deep dive, but Airbnb benefits from a very powerful positive network effect where more guests attract more hosts, which in turn provides more diverse options that attract even more guests, making the entire platform incrementally more valuable. They continue to eat into hotels' market share as well. Travel has evolved to more than just the usual hotel experience, and Airbnb is number one in that special accommodations business, at least in North America, but increasingly across the whole globe. They appeal to travelers seeking unique experiences, benefiting from the tailwind of remote work trends, and have become the dominant player in the growing market of long-term stays, a niche where competitors like Vrbo and Booking.com are really nowhere close by some measures. And for example, if you take exclusive property listings, although there's nothing that would stop hosts from listing their properties on other sites as well, roughly 70% of properties on Airbnb are exclusive to the platform. And that's partly because Airbnb is just very easy to use. Something the CEO, Brian Chesky, is also been talked about repeatedly, but also because most hosts only rent out one property. They're doing this as a side hustle, not a professional business. And Airbnb charges hosts a much lower fee than competitors do. So it's just much more profitable for hosts to add their supply to the Airbnb network and then primarily handle their bookings through them. And Airbnb booking is more profitable for hosts. And that, to me, is the backbone behind their flywheel and network effect. And on top of that, many hosts simply don't want to spend the time cross-listing their property and replying to people on 5 different platforms or paying for some sort of enterprise management software that synchronizes their listings up across platforms.
Very understandable, if you ask me. But the share of professional hosts kept growing in recent years, right? I think during my research, I came across a report from the EU stating that the share of professional hosts has more than doubled from 2014 to 2020. And while it's still only about 13% of all hosts, professional hosts now own disproportionately more offerings on Airbnb, more than 45%. And professional hosts, at least in my opinion, could come with 2 problems. For one, commercial hosts are more likely to cross-list their properties than personal or so-called peer hosts. And second, peer hosting comes with significantly less risk of regulation. When professional hosts buy properties in cities and then list them on Airbnb instead of renting them out to citizens, that leads to more and more dissatisfaction with locals. Just a couple of weeks ago, Spain has actually decided to remove 65,000 listings from Airbnb due to violations of housing laws. And Spain has long been a country where tourism fueled the local housing crisis, and it felt like a matter of time until, something like this happened. Airbnb has stated that this ruling is in conflict with EU and Spanish law and that they will appeal. I don't know how it looks on the legal front, but I think this might just be the beginning of increased regulation against Airbnb in the EU, and especially as professional Airbnb hosts continue to grow. How do you see that affecting Airbnb's growth in the future, and where do you see the impact on that?
You're probably right that it could become a bigger problem than it currently is. And the EU is sort of known for its very tough regulations compared to other markets. We've seen that with Uber as well. The EU is an important market for Airbnb, but about 37% of revenues come from the EMEA region. And in 2023, the EU was home to over 1.4 million hosts, more than any other region in the world. So if this verdict stands and other European countries follow suit, that might turn into a larger problem. And on the other hand, Airbnb boosts tourism, which significantly increases tax revenue for states and is vital to large parts of the population in countries like Spain, which are these really popular travel destinations. And it's not the first time countries or cities have cracked down on Airbnb. We have seen the same happening here in New York City in 2020. And back then it was about unlicensed experiences. And in the past, these regulatory hurdles have tended to pause rather than kill Airbnb's business. And I would be surprised if that changes in the future. At this point, the cat is sort of out of the bag, and I'm not sure there's any more putting it back in.
And to me, the bigger problem seems to be with affordable housing rather than tourism or Airbnb. And that's something governments need to figure out. And as you said, tourism is a huge beneficiary for countries like Spain. Not only the government, but also the millions of people that are either directly or indirectly employed in that sector. And delisting Airbnbs cannot be the answer to more affordable housing. And other forms of regulation might even be positive for Airbnb in the long run, since it would reduce the worst case scenario of, a more severe crackdown. I wouldn't say that risk is what held back Airbnb's stock in the last few years, but it might be one of the reasons why the stock couldn't grow in line with the underlying financials. One other thing I found interesting and wanted to mention here is a comment by Brian Chesky, the CEO of Airbnb, who said he's now seeing more group travel. And as a reason, he said that many people who started using Airbnb when they were in their mid-20s are now in their 30s and, have families, but they still use Airbnb instead of transitioning to hotels. And there's this famous Airbnb ad that I've seen about 100 times that now addresses just this audience.
I think it's safe to say that Airbnb is not just a site for young people, but actually offers a different and in many ways improved value proposition compared to regular hotels. Even more so with the recent push into services and experiences. If I want to book a trip with 4 friends, we are almost certainly going to look at Airbnbs together. So we're all in the same place for one, but also because it's probably more affordable than booking multiple hotel rooms or, now that some of my friends are getting a little older, we're not in college anymore. Like, we're not all trying to split the same room. We kind of want to have our own beds and own space, hence the multiple hotel rooms, which just gets really expensive. But going back to the new experiences offerings, it's not the first time Airbnb has tried expanding its business through this offering. The idea was first introduced in 2016, but it was halted during the pandemic, and Airbnb had never really fully revisited the idea until now. And Airbnb's services offering has a range of hotel-style in-home services, as I would call it. So this includes chefs, massages, personal trainers, hairstylists, and so much more. And that is launching in 260 cities with vetting of these professionals to ensure their credentials and ensure that everything is high quality. And then on the experiences offer, Airbnb is debuting this across 650 cities. And what this is that it features everything from museum tours to ramen masterclasses. So both products are integrated into this redesigned Airbnb app really seamlessly. If you haven't opened the Airbnb app in a while, I would say go download it and go try it. It's pretty cool. The goal is to turn Airbnb into an app that you not only open when you book your stay, but also when you're not traveling. Why not book an experience in your hometown as well? And all in all, this is a logical step for Airbnb. Just like you look for food on Uber Eats, you could look for experiences on Airbnb. That is the vision.
Whenever I want to do anything in my hometown, I never know where to go. So I could definitely need Airbnb to help me with that, even when I'm not traveling. And Airbnb is in a much different position than it was in 2016. The core business is much stronger, and this should be a tailwind when they now try to, establish this new segment. And as I said before, when booking my vacation, I went to Airbnb immediately to look for a place to stay. And then I began searching for things to visit and do while I'm there. Instead of going back to Google or ChatGPT for doing that, it would be much easier to do all of the above on Airbnb. And even beyond that, there's so many more growth opportunities. Airbnb is one of the few tech businesses that does not yet run a subscription model, for example. With the introduction of experiences, there are a lot more opportunities for that as well. To steal an idea that was mentioned in Prof. Galloway's podcast with Brian Chesky, there could be something like Airbnb Plus, a subscription model that connects people locally. So instead of spending your evening alone at your Airbnb, you can meet people with similar interests or jobs in the city that you're currently in. And whatever the details are, the point being is that there are a ton of options to expand Airbnb's core business. And I guess combined with the reasonable valuation, that this is why we are bullish on the company.
Exactly. Airbnb has a lot of runway left ahead of it. And even better, they keep reinventing themselves, which I always love to see in any company that we invest in. I think it's a really great long-term bet at the right price. And of course, as part of a diversified portfolio like the one we're building.
And now let's discuss a company that, compared to Uber and Airbnb, almost seems old. And I'm talking about Adobe. Adobe is another 5% position in our portfolio. And since we purchased it at an average price of $380, it has increased by about 10%. The investment thesis is similar to Alphabet's. The business is a cash flow machine, and it's operating in near monopoly, I would say. Adobe has by far the biggest range of creative products in its ecosystem, and with 95% of the over $20 billion in revenue being recurring, you have very little volatility in the business. However, this is not the case for the stock. In the last 12 months, Adobe stock lost about 10%, and it's now, again, flat over a 5-year time horizon. The question of why that is can be answered pretty quickly. It's AI threats. You can see very similar to Alphabet, but just as with Alphabet, we would argue that those fears are likely overblown, and even more so in this case, perhaps, since Google really has some catching up to do, while Adobe has a significant advantage that it could leverage when integrating AI itself. Adobe could guarantee its customers that everything they do with their AI was trained exclusively on licensed content, and this has made it 100% legal for their clients to use that AI-generated content. This was not the case with any other AI models, especially in the beginning. And combined with Adobe's huge ecosystem and the existing clients that they already had, this just gave them a very good position in the AI race.
Totally. And Adobe benefited from that and the fact that they only needed to be as good as their competitors. And perhaps not even that. They only need to be good enough for clients not to end their subscription and change services and all the frictions that come along with that. And since no other service can provide the same ecosystem as Adobe, I think that's unlikely for a lot of the institutional clients. So their advantage has been a mix of switching costs with their unrivaled ecosystem and the content to train their models. And that gave them enough time to build out and integrate their own AI tools. And then you have to combine those qualitative factors with the valuation. Adobe trades at a free cash flow yield of 4% and a 20 times forward PE. And you buying a company that is likely to keep growing in the high single digits to low double digits across its different segments. And the margins are phenomenal. And the return on invested capital is in the mid 20s. And due to its asset light business model, the need to reinvest into the business is rather low. And things are just changing very quickly in AI content generation, though. So it's an investment we need to watch closely, but we also shouldn't forget that they have their Acrobat and PDF services, as well as marketing analytics, which are also a big part of what they do beyond just offering subscriptions to software like Photoshop and Lightroom that some people think are at risk of being disrupted by AI driven content generation tools. So it's actually a reasonably diversified business that works across a wide range of customers, from advertising agencies to actual, Hollywood studios.
And once again, I would just recommend listening to the episode, because now we go a bit faster through the companies because, the pitches are not as old anymore and you probably have listened to them. So Adobe is a huge business, but we only cover, the most important part now. And in my opinion, Adobe looks really compelling. And I think both of us have the same conviction that we had when establishing the position. And on the earnings side, there have been no updates yet that we could discuss today, because actually they will report earnings later today. And we will, of course, cover that for one in our Intrinsic Value community and also in our free newsletter that we send out every Sunday. Getting to the next company, we have Reddit. Reddit accounts for 3% of our portfolio, making it one of the smaller positions. And it increased about 15% from our average buying price of $87. After your pitch, I wanted to give Reddit another chance as a user, and I kept up with the company news even more so than I did before, because your pitch really got me interested and excited about the opportunities Reddit could offer in the future. But from a user perspective, it just is not my app. I see myself closing it after a few minutes, and I don't really come across content that I personally find interesting. Although I must say that in Reddit's defense, I barely consume any social media. I also don't know anyone who does regularly use it, which is not too surprising since the US is still by far Reddit's biggest market. But that is changing slowly, or actually rather quickly. In Q1, we saw international traffic really take off, going 41% year over year and actually outpacing US growth, showing that the efforts of translating content through AI, which you mentioned in your pitch, is actually paying off. And it's only natural that international expansion will also take more time than, with other social media apps, because the community structure that is at the heart of Reddit just takes longer to build than an Instagram feed. But the international growth also comes at a cost, because American users are monetized at much higher rates than international users, especially those outside of the EU. And the international ARPU is only about $1.30, and that's the average revenue per user, while the US ARPU is significantly higher at over $6. Is that something that worries you longer term, or would you just say that's a short-term price that as a Reddit shareholder, you got to pay for longer term success?
In the short term, that might be a drag on earnings growth. But if you want to invest in Reddit, you need to believe in the premise that international ARPUs will over time converge. And of course, ARPUs in South America might not reach the level of the US, but they can get closer. And the Western European market probably has the potential to become as profitable for Reddit as the US one day. And it will all come down to the effectiveness of their advertising ecosystem. Reddit is already significantly expanding its advertiser base. We see revenue growth outpacing daily active unique visitors, which suggests that more advertisers are joining the platform and the ad spaces are becoming more valuable. I can certainly say the ads have become a lot better on the US app. They're targeted to the niche and the topic of the subreddits I visit, and I can see why their effectiveness has just gone up tremendously. Has your experience with that changed at all, Daniel? I think the last time you said the ads maybe felt pretty random and untargeted.
It depends. It depends. When I'm just going through the feed, I get all kind of advertising, ranging from, Amazon Prime or well-known fashion brands to scammy looking mobile games or dating sites. But in a specific subreddit, the ads do actually get more targeted. I'm still struggling a bit with the idea of Reddit reaching anything close to Meta's ARPU, but in your pitch, you pointed out that Reddit has a special culture where paywalled or sponsored content and even advertisements, or really just anything that looks quote unquote capitalistic, is disliked. And of course, that's not true for every subreddit, but it does make me wonder whether this app can ever become as profitable as, for example, Instagram, where selling ads for makeup or clothes just feels like the most logical thing to do. It probably doesn't help that Reddit is still also a bit known for its explicit content. And there is still the dependency on traffic from Google search, which we also discussed in the pitch. And our listeners can probably imagine we don't see that as a big problem, but I'll still ask you whether you see any scenario where a drop in traditional Google search and even more AI tools could hurt Reddit.
I use Reddit pretty frequently, and I have not yet once thought, oh, ChatGPT is going to give me a better answer than this. Reddit searches are much different than the ones you would go to ChatGPT for. And I feel like that has been a recurring topic in this episode of the different ways that we search for information and how it is likely to stay different. Of the way you search on Google, the way you search on ChatGPT, and the way you search on Reddit are all distinctly different ways to consume information that have kind of a niche over people's habits. And so the reason you go to Reddit is you want to get feedback from real individuals. And that's the whole idea. And AI could summarize what they're saying, but it loses the core of what makes Reddit's content unique. And if anything, I can imagine that instead of just adding Reddit to the end of Google search, you'll now more often land on Reddit through these AI tools like Perplexity and ChatGPT that use Reddit as a source. Because they're like very heavily trained on Reddit. And that's actually part of the thesis for Reddit, is that they're going to keep earning money from licensing out their content as this continuous stream of real world, up-to-date, human-generated content to feed these models with. And maybe it'll be Gemini too. So yeah, since the whole idea of the platform is to create a network for discussion and real interaction with people, despite its anonymity, I don't see AI taking that place. A bet on Reddit is a bet that digital communities and the need for human connection and feedback will persist in an age of AI. And I actually think in an age of AI, actually genuine human interaction, if only on a digital platform, will be more valuable.
I think so too. I think that's one of the things where people just want to participate or keep participating despite AI. I still could see traffic from Google or AIs decrease though, since people like me, for example, who land on Reddit through a Google search, do not really look for that social aspect of the platform. I just want an answer to my question, and Google's AI overview will probably give me that. Having said that, those queries are not valuable interaction for Reddit anyway. Monetizing one-time visitors from Google is more difficult because you don't have the data, they are not logged in. But despite me not being a user, I do see the need for social interaction and a community feeling that Reddit offers. And I don't think AI is a threat here. And as you said, it's kind of a repeating theme today, discussing, what queries are easy to monetize and what not.
Yeah, I think the biggest start with AI is just managing spam from chatbots that are can undermine the human content that is created on the platform. That is something I'm watching. But looking at Reddit's latest results, the numbers just look really good. And the stock jumped 17%. So for what it's worth, the market agrees with us as well. Revenue is up over 60% year over year, and active users increased by 30%. And no matter what set of numbers you look at, Reddit surprised to the upside on all fronts. Reddit CEO said that after 20 years, he's never been as excited about the company's future as he is today. And I actually understand why. A couple of years ago, I couldn't see this company becoming profitable. It was kind of like what I thought of Uber. So obviously I don't have the best foresight in the world, but now I can see it on a path to become one of the most profitable social media companies out there. I believe their earnings power will only continue to increase from here. And Reddit hosts roughly 100 million daily users who generate uniquely searchable, topic-centered content. And yet, as you mentioned, its average revenue per user, ARPU, remains a fraction of Meta's. And so monetization levers are just beginning to scale. Contextual ad revenue grew about 60% in 2024. And those high margin data licensing deals with AI developers are contributing to about 10% of sales. And so pilot programs for paid subreddits, marketplace fees, and multilingual expansion could bring further ARPU upside. And because there's this base of unpaid moderators that handle content policing, operating costs can rise much more slowly than revenue, giving management a clear path to dramatically expand margins. If ARPU even approaches half of Facebook's, and international user growth continues, earnings power could plausibly triple within the next 5 years, leaving today's post-pullback valuation at really a mid-teens multiple of future cash flow, which I think is not too bad for this type of business.
Looking at those numbers, the growth potential is just undeniable. Those numbers were fantastic when I looked at them the first time after seeing the earnings report. And you cannot even argue that the numbers are looking good because the base is low. As you said, they already have 100 million users. Growing at that rate is astonishing considering that. And the contrast to our other positions is probably that Reddit is not necessarily cheap. Reddit is trading at 15 times sales and a forward PE of 82. So the market definitely is seeing these growth opportunities as well. Actually, right now, Reddit is trading at your exact fair value target from your model, which is $117. That's based on sales growth of about 26% and 5% operating margin expansion every year, driven by double-digit growth in the US RPU and even faster in the international RPU. That might sound optimistic, but I think for everyone who listened to the episode and looking at the latest results, this is in line with how things are currently playing out. Still, the position is not 3% for no reason. There's a lot more uncertainty than in the other positions that we hold, and this investment case expects Reddit to succeed with its plan, no hiccups in monetization or growth. And I'll be very interested to see what path Reddit will actually take in the years to come.
A lot has got to go the right way with Reddit, but currently things are looking great. So that's something we can't say about another portfolio company, which is Nike. That's why this business is only a 2% position. Fortunately, at your guidance, Daniel, we paid a lot of close attention to price. And so Nike is up about 10% since we bought it. So we've done well there. And maybe I'll just give a quick summary of the Nike investment case, since you've done such a great job breaking out some of the other portfolio companies. Nike's recent struggles trace back to a strategic mistake, as you know, under CEO John Donahoe, who doubled down on the direct-to-consumer model. And the idea was to boost margins and control the brand experience. But in the process, Nike pulled back from wholesale partners, scaled DTC too aggressively, and flooded the market with these high-volume, less popular releases that really just diluted the status of its more classic designs. And at the same time, innovation stalled out, signature lines went not stale, and performance categories like running lost market share to upstarts like On and Hoka. And all of this resulted in a weaker brand, excess inventory, and a wholesale reversal in strategy as Nike now tries to win back those lost partners and just win back consumer loyalty. Since Nike didn't report any new earnings since we last covered it, there's maybe not too much to add, right? Or did I miss anything in the summary here?
No, you did a great job. It was short and sweet. And we do have no earnings for Nike now, but we've got some news related to the business. And that's actually about Amazon, because after exiting Amazon's marketplace in 2019, Nike has now announced that it will return and once again sell directly through Amazon. And that's pretty much a 180 to the Donahoe era and plan, which was defined by a major push toward, as you said, direct-to-consumer channels, positioning Nike as more of a premium or even kind of a luxury brand. But rejoining Amazon now represents as sharp of a pivot as possible. But let's face it, Nike received pretty clear feedback that if consumers can't find Nike at their local retailers, they will just buy other brands. I still believe Nike, at least long-term, will be the brand of choice for most people, but the DTC attempt has apparently been a wake-up call for Nike. Now, Nike is back to its old motto, serve consumers wherever and however they choose to shop, and Amazon, for its part, has been actively trying to improve its image with higher-end brands. It just recently launched Saks on Amazon, a new initiative that is featuring labels like Dolce & Gabbana. Next Return fits well into that broader strategy, I would say, and if executed carefully, this could be a mutual brand benefit. Amazon boosts its credibility with premium consumers, and Nike really gains reach without completely sacrificing control.
I like the strategic shift. I don't know if it will bring Nike back on its feet, but Nike just isn't a luxury brand either. They should serve customers where they are. And And you just don't go the extra mile to choose Nike shoes instead of a dozen other brands. And maybe that was true 30 years ago when Jordan was dominating the NBA, but I just don't, that's not the world we live in now. I personally feel pretty indifferent toward a lot of the shoe brands that I see. And part of it is just retail is such a tough business. And if it weren't for the immense size and the global brand that Nike has, I don't think we'd be investing in a retail brand with as many problems as Nike. And another problem, of course, has been tariffs. And on that front, the market seems a little bit more tranquil now since we recorded that Nike episode. And when we recorded, that was like a really turbulent moment in markets. And so it seems like the worst case scenarios won't materialize, hopefully.
I still remember when we talked about Nike, I think it was the exact day of when the whole tariff disaster happened, and it was pretty turbulent times, but at least right now it looks like the worst is not to come. And I don't know though if that will help Nike's next set of earnings, because they will still look pretty bad. They still have inventory problems weighing on the gross margins, and revenue is expected to see significantly declines, likely in the mid-teen range, and all of those guidances were given before all of that tariff stuff happened. So there's still a lot of work to do, but what I like to see is that when I talk to people, especially from our community who are not US Americans, all of them look at me with these big eyes when I tell them that Nike is supposed to not be a big brand anymore, because the brand image, especially outside of the US, is still very much intact. And if I can see that and hopefully a significant reduction of inventory in the next earnings release, well, then I can see fewer discounts going forward, which in turn should help recover the brand image, perhaps even in the US as well. And combined, so the thesis, this should get Nike back to past revenue and margin levels. And that would be very bullish for the stock at its current levels. I do believe Nike will get there. They still have the most talent working for them. It's a global brand, as I said, and they do still have the most prominent athlete portfolio in the world. Sometimes I hear that they lack these all-time greats right now, but I mean, I'm a Messi fan, but I will still say Nike has the most famous athlete and arguably the most famous person in the world under contract right now, and that's Cristiano Ronaldo. And if I'm not mistaken, Shawn, recently you had the chance to speak to an industry expert who affirmed that Nike should reclaim their spot in the long run. Their scale, opportunities to invest, and their brand strength is simply peerless.
I have a friend who does actually work at the cutting edge of shoe design, doing research on how different shoe designs perform. And how cool is that? That's a cool job. I walked away though after talking with him with a better appreciation for just how badly Nike has messed up in recent years, but also a better idea of how, despite that, the company has the brand and the talent to bounce back. It won't be easy, but the feeling was that Nike should have never found itself in this situation of even losing in the first place. Yet that doesn't mean it will continue to flounder. Now that everyone is on the same page about the mistakes that have been made, there's a pretty good reason to think that they can turn the ship around.
Well, let's hope so. And by now we already have a long episode, but I knew this one, reflecting on all the companies that we own, will be quite a long one. And we have one left. For the sake of completeness, we need to also quickly mention that we added Nubank to our portfolio just recently. This has been our most recent addition, and I could imagine most of you will probably have listened to that episode, so we'll keep it short, but still, how about you give us a quick overview of the investment thesis and explain why we initiated a 2% position at a cost slightly below $12.
Well, Nubank is not necessarily in our circle of confidence, which I think we can both confidently admit, but we decided it was worth taking a calculated risk on this company because the numbers and economics of this business are just incredible. And the reason I say that is if it ages poorly, we can point to this moment and say, you should have known better. You said this was outside your circle of confidence, and this is a great illustration of why not to go outside your circle of confidence. But
very nice.
Nubank, but yeah, it really makes you bullish, right? But Nubank was only founded in 2013. And so despite being such a young company, nearly 60% of Brazil's adult population banks with Nubank by now. And with over 80% of those customers acquired through word of mouth referrals. That just speaks volumes to the quality of the product. And Nubank began with just these simple credit cards that charge no fees and has since expanded into other banking services, including debit cards, insurance products, and more. And Nubank has consistently grown its revenue per customer as they have become more reliant on its services.
It has also been a great example of the model of shared economies of scale, right? I mean, Nubank operates with significantly lower operating costs than all those legacy banks in Brazil just due to its digital-only model. And these cost advantages can then be passed on to consumers by offering credit cards with either no or lower interest rates or generally just cheaper products. And that value proposition attracts new customers, and I guess that's why 80%, which is an insane number, 80% of customers were acquired without any paid advertising. And then the flywheel just keeps spinning, because if Nubank can acquire new customers at almost no cost, the unit economics just look out of this world. I think you mentioned in your pitch that Nubank's average lifetime customer value relative to their acquisition cost is something like 20 to 30 times higher.
That's right. And of course, all of that does not come without risk. And without going too much into the detail here to be repetitive, the main risks revolve around currency volatility or devaluation and the quality of the loan book too. Whenever a financial institution grows as rapidly as Nubank, there is a risk that it's taking on riskier loans than it should. And the concentration of retail clients and that retail loan book as a percentage of its total assets. And all of this wouldn't be visible in good economic times, but when the tide turns and the economy loses momentum, which can especially happen frequently in Latin America, we could see that Nubank has taken on too much risk. That's the big concern. And when I valued Nubank, I tried to account for the higher risk and uncertainty of its earnings by using a much higher discount rate than usual. And so my growth assumptions were also slightly below estimates, and I tried to consider in a significant multiple compression from 40 times earnings to really only 22 times earnings in a couple of years if we were to exit the position in my model. And despite all that, when you buy the shares at a price around $11, the expected return, and that return is by no means guaranteed, is about 16% per year as a rough ballpark way for us to think through what we're getting into.
And that's an insane potential upside, because if you take a multiple and just cut it in half, still getting, potentially a 16% per year return is just out of this world. And as you said, Nubank is not necessarily in our circle of competency, but looking at the numbers, the growth opportunities ahead, and the incredibly strong value proposition that it seems to have with its customers, I believe it's worth taking the risk that an economic downturn might bring with Nubank. And again, it's only a 2% position right now. Well, we're used to covering a lot of companies, but going through all of them in just one session is something we haven't yet done. And I think it takes a while, but at least to me, it felt like a very good conversation. And we both hopefully learned a lot, just as well as the people who listen. And I hope we are able to, not only give a good overview of the companies we own, but also give you some insight how we think about why they are attractive right now. But before we close it for today, let's briefly, and let's really keep it brief, discuss our general thoughts about how we structure the portfolio, how we think about position sizing, although we already talked about it in the episode, and also what companies we look for. We often get the question of why we build relatively small positions despite still having such a large cash position. And my first answer would be that this makes it a lot easier for us to communicate our different levels of conviction. Our goal is to own approximately 20 positions, and that would mean equally weighted about 5% per position. These 5% serve as somewhat of a yardstick. When we feel very good about an investment, we invest more than 5%. And when we feel like there's more risk in that position or just more uncertainty about the potential payoff, then we tend to invest less than 5%.
And on this show, right, we want to show the process of building a portfolio from week to week. It's a journey that we want people to be on alongside with us, whether they agree or disagree with some of the decisions. And if we were just to go ahead and buy all the companies we find attractive, then we just wouldn't be offering much value. You can look at plenty of portfolios of investors online who have these finished products. But what we're trying to do that we think is interesting is allowing people to watch the process of building a portfolio in real time. Granted, we're not actually having the pressure of, managing a hedge fund and having investors who, want certain performance benchmarks. So we can be much, much more patient and deliberate about how we do it. But really, that is how investing should be done anyways. And so what are the considerations when entering a position, and why is a position only valued at 3% while another is valued at 8%? And just like we want to teach the process of valuing a company, we want to teach the process of building a portfolio. And we are by no means flawless at doing this. I'm certain you have all seen us making mistakes in this process, and we're being transparent about it. And that is really all you can do.
It's just about the learning process, right? For the listener and also for you and I. And let me maybe add to that we do not have to own 20 companies. We have those 20 companies in mind, but when we do not find enough good opportunities, and we are really trying to, I mean, we pitch a new stock every single week, then we don't necessarily need to own 20 companies. We can just, own less and then ramp up the positioning of each stock. And also, if we would already know 20 great positions, then of course we could add them. But I don't know about you. I do not have 20 companies in my mind that seem to be perfect and, profitable investments. And that's why we go into a new stock every week to just find those companies. And that's a work in progress, right?
It is absolutely a work in progress.
It sure is. I can attest that to every listener. Behind the scenes, we're doing a lot of work for these deep dives and figuring out what companies worth revisiting or, even just looking at for a first time. And, another question that I often get is about the type of companies we look at for our portfolio. I think we were asked that on several occasions. I think long-term listeners know that we cover pretty much everything, different geographies, industries, market capitalizations, some fast growers, some slow growers. There's really not a boundary, although we are a bit limited when it comes to covering smaller companies, micro and small caps. Unfortunately for me, since I like to invest in those companies, but that's just something we cannot cover on the show. We can do so in the intrinsic value community, but here on the show, we have a bit of a problem due to, the size of our audience. We want to avoid any stock that could be influenced by what we say here on the show. And of course, these companies just generally come with a lot more risk, and you need to be more up to date on their news. And this format, this podcast is just not, able to do that to the extent that you would need to do it if you want to invest in micro or small caps. However, despite covering so many different styles of companies, when looking at our portfolio, there is a bias towards large cap, mostly US based, and most importantly, tech or platform based companies. There are some reasons for that. And for one, these are inherently strong business models. They're asset light, they're easy to scale, and with ample room for expansion. And another reason is that the ones we own have come down in, price and valuation a lot due to concerns about the possible disruption of their business model. And that's why I see the next big narrative in our portfolio, Alphabet, Adobe, and Uber. All those are companies that trade at low or reasonable prices because of megatrends like AI or AVs, and they are supposed to hurt their business model. And for all three companies, we argue, as you've heard in this episode, that in fact they are beneficiaries of these megatrends, or in Alphabet's case, at least not in as much danger as the market currently believes or thinks.
It's funny. I didn't think, honestly, that we'd have such a tech-heavy portfolio. I started out hosting the show solo, and my first idea to explore was Madison Square Garden Sports. And then I passed on Coupang, the quote-unquote Amazon of South Korea, before adding Ulta. So we definitely did not start with this big tech focus, but we've certainly found these to be some of the best businesses we've ever studied, and not always at as unreasonable valuations as you might think. We found Amazon to be kind of richly priced at the moment, or at least I did, but it's a company we'll also probably want to add if we get some volatility that we can take advantage of. So we really have become a bit of a tech-centric portfolio. Maybe that will come back to bite us, but I think we still feel pretty good about the quality of these companies and the valuations where you're able to purchase them at, which is not to say that these companies are necessarily as attractive at current prices for the ones that have risen substantially. So personally, I'm not loading up on Reddit, Airbnb, or Uber right now based on where they're currently trading, but I definitely would love to in another big drawdown and increase those positions in the portfolio so we can put that cash to work as a percentage of the portfolio and shrink it down a bit. But price really matters, folks. That's the theme of the show, because many of the companies we cover are very, very impressive businesses that we'd want to own in theory. And so really these episodes are more of a discussion about, okay, can we get them at reasonable prices, which isn't always the case, as we've seen with Coupang and Shopify, and to a different extent with Amazon.
Well said. Well said. And the episode has been quite long. So with that, why don't you just give us the hints for the upcoming episode, which will be one of our usual company deep dives or pitches again?
All right, let me start by saying that this company actually has a very similar story to Berkshire Hathaway in many ways. And actually, the results have been more impressive in some ways. And I'll also mention that, of course, this company is a conglomerate too, but a conglomerate focused on a more specific industry than Berkshire is, which owns a pretty wide variety of companies. And as a last 10, I'll say that this company's products are not priced for the frugal. They command a pretty high price.
I think I know what company is up next. And I think those are some very tough hints. I don't think I would get this one, but our audience is way smarter than I am. So let us know your guesses in the comments. And with that, let's close it for today's episode with a quote by Peter Lynch that might fit a portfolio review quite well. Know what you own and know why you own it. And having said that, have a great day and see you next Sunday.
And on that point, Photoshop has been the industry standard for 40 years. And at any time, you could have probably convinced yourself that some new competitor or technology would upend Adobe's leadership. Right? Like, I don't want to sound like somebody who doesn't understand the innovator's dilemma and how companies can be disrupted, because that does happen. I mean, in reality here, we're talking about a very long runway of dominance, and they've only continued to invest in making the service more powerful and just compounding their advantages, further entrenching Photoshop's position, for example, as the industry choice for image editing software.